Peter, I like the message. It's very clear, it seems, in your latest report. Don't be a hero. Don't try and swoop in and buy the dips. Is that every dip? Is it just certain types of dips and certain stocks? Walk me through it.
I think right now we want to see where this all plays out. I'm looking for the NASDAQ 100 to get back to at least its 100-day moving average, which I believe is 10,400 or so. And I think it could crack through even a bit below that. My biggest concern is that we are not going to get stimulus out of DC. The job data is not coming around great. We're seeing coronavirus spikes in Europe, but I think we're also starting to see a slowdown in the reopening here. Certainly it's stagnating. So I think there's a lot going on that makes me pause and be cautious here.
Peter, I want to put the context here of the way you've thought about the market. You were bullish early on in the spring, summer. You've been a little bit more wary in the last run up, maybe the last month, right? This last kind of explosive move in August. So does that mean we're just wiping off the froth that never should have been? Or is this real reversal that could take us down even beyond that kind of last big bubbly couple of, months, weeks?
I think right now I'm just looking for a bit of a reversal where you get a pullback in some of the names that have done really well. I think you're going to see strength in the names and sectors that lagged. We've got these story stocks that we got to figure out, were they the right value? Great companies, great growth prospects, but valuations may got a bit out of control. So that's really what I'm looking for, a little bit of this reversal where you might get an overall down market, but most stocks are going to do okay. I think you got to be very careful in the fast growing names. The one thing you keep hearing a lot about is, well, if the stock got here, I'd buy it. Well, the stock's starting to come here, but it's here for a reason. And I think that's going to give a lot of people pause. I think they're crowded trades. So I think there's more room for those high-flying stocks to pull back.
Peter, what we saw last week that seemed maybe the most alarming here for some of the leadership is, even though some of the quarantine trades were holding on all right, Peloton did okay last week. We had a little strength in Zoom again, a little bit of a rebound, Tesla too. Apple, Facebook, Amazon, the giants, the ones that really guide the market, were making new lows. What do you want to see from those types of companies, either in terms of technical patterns or in terms of percentage declines? I mean, is there anything that makes you feel like, all right, we've had enough, or the market here is moving on from just a little corrective measure?
Yeah, I would say generically, I look at some of these stock prices where they were in February. They already had a good story in February. I don't think they should be below February. I certainly think they should be higher than February, but some of them are still 50% above those levels. So I think you see something at a closer pullback. Even today, right? Walmart's now part of this potential TikTok. Walmart was a company to some extent almost left for dead. And I think people underestimated the chances of some of these more traditional companies to figure out a way to participate in, quote unquote, the new economy, especially given the market values that are assigned to the new economy. So I think you're going to see that competition from some of those old line companies figuring out ways to participate. So that's why I see a pullback, not to the February levels. I think these companies still deserve valuations better than that, but not to the extreme levels they were priced at.
All right, I like that perspective here. So looking kind of where things were pre-COVID, and if they are able to perform in this environment, take part in that new economy, that maybe they deserve to be higher. Do they deserve to have their stocks as high as they've gone? Another question. I think another one here, Peter, is what could turn the market from being this bifurcated market along cyclicality and value versus growth versus something that's broader and more kind of an asset class sell-off? It seems like we're getting that a little bit this morning, but so far there's been a stark outperformance of the non-tech and non-quarantine trades in this month of September. How do you gauge whether or not other stocks get wrapped up, and if the outperformers of the last month get dragged down too? What's the thing that needs to happen for a broad market sell-off?
So I think a complete lack of stimulus. If it becomes clear we're not going to get stimulus ahead of the election, that is a real concern. And then this whole friction with China, right? There is more and more angst with China. It is clearly a part of the Trump campaign is to, escalate that fight with China. The Democrat side also seems comfortable fighting with China. This has really moved to a national security issue. You're seeing that in the headlines. I don't think it's being reflected in the stock prices, but watch for this friction to continue over big tech and the direction that's headed for the global economy.
So we've got a few of these macro risks, some geopolitical in nature. What about from the central bank side? Is there anything that we can hear that is going to turn that around, or did we get the message from Powell next week and we should expect that to hold?
I think we got the message from Powell last week. They're pretty much all in. They can do something new if they had to, but they're not going to do anything new or super creative unless you see a significant deterioration in the stock market or a significant deterioration in the credit market. And the credit market really is still doing okay. In fact, it's doing better than okay. Bonds are coming, it's trading well. So I don't see any reason for the Fed to take any additional steps. So they're not going to support the market for that next 5 to 10% down.
So the reopening trade is subject to European flare-ups right now. I know there's worry about the virus during the fall, winter, as well as whether it gets colder. How do you gauge that as another one of these catalysts? I mean, are we still looking at curves, Peter, and growth rates and all these COVID-specific items as being an input to the market? Because it seemed like we got away from that a little bit. Now are we coming back as we're on the downside? Is this another focal point for potentially more incremental negative news?
I think we're looking for that. And the thing that I keep coming back to is I keep looking at the unemployment rate and the jobless claims, right? The jobless claims are persistently high. And if you start looking through the data, what you're seeing is, to make it very simple, I guess, is 3 months ago, relatively low income people were getting laid off. They kind of viewed it to some extent, I think, fairly as, okay, I'll get a couple months off while we do this, COVID fight. So they weren't even that worried. They were getting $600 from the government. You fast forward now, I think the average unemployment, pre-unemployment wage is higher. So people are losing more. They're only getting $300 extra from the government at best. Not everyone's even getting that. And those who remain jobless are now trending over 15 weeks, which I think you've got to really have that thought, like, can I get this job back? Is it really coming back? So I think the psychology of that's very different. And so back when we had 18, 20% unemployment, it didn't matter that much because people were cash flow positive even in cases. Now you're only at 8% unemployment, but I think these people are hurting. They're getting very nervous, and that's going to be a big drag to the economy that I think starts showing up in the data in the coming 2 to 4 weeks.
So, Peter, it doesn't sound like you've got a huge amount of faith in the reopening narrative. Sounds like on the tech narrative, you think there's still froth to be wiped clean, most likely. So let's just cut straight to it then. I mean, if we've got the Fed on hold, tech revaluing lower, reopening not able to provide a good buffer, have we seen this market top for some duration of time that is lengthy, that is long? I mean, I don't know about the top or how we define cycles anymore. It's so messed up. But should we look back at what we saw on September 2nd as a peak we don't get back to anytime soon?
Yeah, I think that's fair. I think we want to be very cautious coming into the election, seeing how this election plays out. There's all sorts of scenarios that could play out. Some would be very good for stocks. I think many would be questionable for stocks. So I think we want to be cautious, see how that plays out, be very wary of chasing bubbles. And if you want, look, some of these dividend stocks, for example, you look at some of the big dividend ETFs, they're below where they were in June. Rates are staying low. The US economy is going to do okay, maybe not great, but a lot of those companies will survive through that. So I think it's time to start getting away from chasing growth, maybe looking at some value, maybe looking at some dividend stocks, and finding ways to keep your income stable so you can participate somewhat in the upside and be nimble.